Fund Supermart, your online gateway to unit trusts.
What is your outlook for global equities, especially after the Brexit and lingering concerns over China's slowing growth? Is it a good time to invest in the current climate?
Right, I think the outlook is particularly uncertain. We've had a few big surprises, like the majority of the UK voting to leave Europe. China remains very volatile. But I think the big uncertainty is the direction of interest rates in the developed world, and whether the world is on a recovery path. It's been now 8 years since quantitative easing started after the global financial crisis. And we had that initial 25 basis point rise in interest rates in the United States in December last year. And people were expecting that to spell 4 or 5 increases this year initially. We haven't had a single rate hike since then, and the economy doesn't appear to be recovering very strongly, if it's recovering at all. So that is the great uncertainty. The positive is that I think a lot of emerging markets have got enough ammunition to be able to stimulate their own economy, even though interest rates may remain unchanged in the US or developed world, or even if they go up. And we've seen Indonesia, India, Australia, Malaysia, Taiwan, all reduce interest rates to try and put some life into their economy. But uncertainty means that you have to invest with a fund manager, we believe, that actually is very familiar with the companies from the bottom up. It's very hard to predict what the economy is going to do, but it's more, we can predict with more confidence the outlook for individual companies that we go through. And remember, all our staff, a lot of our investment professionals are in the 31 offices we have all over the world, visiting companies to try and get familiar with and stay familiar with the companies and work out their value. So if you have the right fund manager, now is a good time to invest, yes.
In light of this, how have you positioned your portfolio to mitigate uncertainties? What are the key risks that investors should be aware of?
Well, opinions differ. A lot of people say you should put all your eggs in one basket. I think Warren Buffett says it means you must be really worried about your baskets if you put lots of eggs in different baskets. But we tend to invest from the bottom up without any real geographical bias, because we don't really look from a top down at economies. However, we like to pick the best companies from the bottom up, and that might adjust the global mix. We find that as a result, our portfolios tend to be underweight the US. They tend to be overweight emerging markets throughout the world. And a lot of them tend to be companies that are in economies which don't have to depend too much on external demand. So if you believe that emerging markets are in actually a more healthy state than the developed markets, and that you want to invest in companies that have a clear growth in revenues and profits and don't depend too much on how the world economy turns out, then I believe that Aberdeen Islamic World Equity Fund is a good way to do it.
So you've mentioned that you've underweighted US. Our research team has recently downgraded the star ratings for the US to 2.0 stars unattractive and also Europe to 2.5 stars neutral. Do you share the same conviction with regards to both of these markets?
Well, if you look at the economies of Europe and the economy of the US, yes, I would agree. As far as companies listed on the stock markets is concerned, there might be some difference of opinion, but certainly the United States has performed extremely well, or the US equity prices have performed particularly well. But a lot of that is a result of share buybacks and reducing the number of shares there are in issue for individual companies, which enhances earnings per share. So it's rather artificial, and much higher dividend payouts in the United States, which means that the dividend yield can be better. But in fact, if you borrow money to buy back shares, and if you borrow money to pay out higher dividends, rather than using your profits to do these things and carrying out capital expenditure to expand your capacity, then I think the outlook isn't that bright. And we've now got to a point where share buybacks and dividends paid by the S&P 500 companies exceeds their actual profits. So it's been a rather artificial rally in the United States. So I would agree that the United States upside appears limited on valuation grounds. In Europe, of course, there's the danger that other European countries within the European Union will join the UK. And a large chunk of their population, I think, would like to exit the European Union as well. So politically, and as a result, to some extent, economically, there's a downside there. However, there are companies listed in various European stock exchanges, particularly, UK, no longer Europe really, is it? France, Germany, Switzerland, Sweden, that actually have businesses which gain most of their profits and revenues from outside Europe, mainly in emerging markets. And those are the companies that we're concentrating on in those European markets. And in fact, a lot of the US markets are companies that have competitive advantage and sell a lot of their products in emerging markets. So those, I think, still offer very good value, and we will continue to be invested in. And our portfolio at the moment is overweight Europe, but that doesn't mean it's overweight in its exposure to the European economy. It's just that a lot of good companies happen to be listed in these markets that I just mentioned.
What is your expectation for global emerging markets for the remaining months in 2016?
Well, I think we've reached a point in global emerging market valuations in which their discount to developed markets has reached quite an extreme level in terms of price-earnings ratio, price to book. And now a lot of investment houses are starting to look at the earnings outlook for emerging markets in the world, and the growth looks more healthy than it does in the developed world. So I think that people are starting to hoist in that valuation gap, and it's likely to close. In addition, I think people have gone very underweight global emerging markets. Aberdeen Asset Management has got quite a large exposure to emerging markets throughout the world, and we've seen quite a lot of redemptions in emerging markets over the past 2 to 3 years. But that might have reached its trough and will be recovering quite nicely, particularly as the growth outlook appears better. And the other thing about emerging markets that's different from the developed world is that you get a return for your money in the emerging markets in terms of just simple deposits or interest rates, whereas in a lot of the developed world, particularly Japan and various pockets of Europe, such as Germany, Switzerland, Denmark, you're getting a negative return. So the world is desperately chasing a real return. Here in Malaysia, you have a 10-year Malaysian government bond giving you 3.8% return. Inflation's 1.6%, according to the latest CPI numbers. So you have a real return of 2%. Now, there's many economies where that number would be negative. So that's the other attraction of emerging markets that I think is going to lead to the second half providing a better performance for global emerging markets.
Where do you find the most promising opportunities within global markets? Are there any countries or sectors that are likely to do better this year?
Yes, I think I mentioned before that there is great uncertainty at the moment on how the world's going to pan out, whether interest rates can be raised in the United States, whether there is enough economic growth to get it above stalling speed in Europe, the US, Japan, of course, and China, which has now fallen to some 6 to 6.5% GDP every year. And with that uncertainty about the global growth, I think it's best to be invested in economies which are self-contained and have a domestic economy that is helped by a population dynamic, a large proportion of the population being of employed or employable age, and there being work available. The two most insulated economies from that point of view would be India and Indonesia, where we happen to have significant overweight positions and are invested in companies that really cater for an emerging middle class and growing domestic demand. So those would be the two off the top of my head that I would recommend: India and Indonesia, where we have been investing since 1987, 1988 in the case of Indonesia. In the case of India, more recently because the market became investable at a later date. But certainly you don't need to worry about exports so much, and these economies are to a large extent self-sufficient. So it's that growth in the middle classes and the higher income for the lower classes that is leading to domestic demand, creating that growth.